Jack, just to kind of set the scene, right? We had what now appears to be a little bit of an overshoot to the downside in December, a panic about imminent recession or some kind of other disruption, taken back about half of the overall losses from the fourth quarter. We're back to early December levels.
Sure.
Earnings have been not so great, but better than feared. Can that equation work for much longer from at this point, just not being as bad as we thought?
I think not as bad as feared can carry you for a part of the time. I think the shift in Fed policy away from we're going to tighten to we're going to be even more data dependent than we hinted at being, and perhaps pausing for good, or for at least some extended period of time. And then I think if you look within the earnings story is okay. While you have, and you mentioned a large tech bellwether spending a little bit more than people were expecting them to, at least it speaks to other companies' top lines are possibly going to be better. It speaks to the reinvestment in people. It speaks to, I think, an expanding economy. It might be expanding at perhaps only acceptable rates rather than the euphoric rates we were counting on 9 months ago or a year ago. But I think it's still a positive backdrop from here.
Chris, as a portfolio manager looking at individual names, does it feel like the ones you wanted have gotten away from you to the upside now, or is it still an environment where it seems like things are reasonable and you can find ideas?
The lows of December certainly were exaggerated to that end, and January's been a great month. So I think a little bit of caution out there. I think you really want to be selective as to where you're putting your money. We're getting into the heart of kind of earnings season for some of the smaller cap companies, and we are seeing some variability in their earnings. Some people are calling out tariff issues or other geopolitical impacts and shifting out of China. Your prior guest was talking about that, who I think was right on target. There is shifting out of China production, the assembly lines. And as you get through a couple quarters of that, the long-term trends are still there, but there is that kind of volatility in the earnings, which is okay. And for an investor like us, I'd see it as an opportunity to deploy capital.
Hey, Chris, if you just talk about the small caps, I mean, the Russell 2000 is still almost 13% below its highs from last year. Does that give you more of an opportunity there, or is there a reason that it's still down 13% when the Nasdaq's climbed out of correction territory?
I think the limited liquidity in that space has certainly put some pressure on those names. But longer term, we still see a lot of opportunity and value. We still think that M&A can occur as larger companies come down to buy those. The smaller cap companies in the past have thought that they weren't being as exposed to the global trade, but they really are, because we've become a global economy with a lot of those exporters. But small cap companies, the high yield market right now is more supportive. We saw that coming down very hard in December. That's generally an indicator of weakness in that. But we've recovered some. I think if we can see that continue to recover, that'll be more supportive for the asset class.
Jack, if you look at these previous, 20% market declines that were not associated with a recession, there's been, several of them over the last few decades. The Fed kind of gets spooked, gets more patient. You have very good market returns, but that's because it wasn't the end of a cycle, right? So Is that your premise, that this is just a lull or a bit of a slowdown?
I think this is more of a slowdown. Perhaps we're going to see a little bit more earning pressure rather than typically you tend to think of the equity market discounts 9 of the next 5, 9 of the last 5 recessions. We don't think we're discounting a recession. We think actually that recession is pushed further out. And I think if you look with what's working, it's certainly probably the most credit sensitive parts of the stock market. The auto stocks are up, the home builders are up, the consumer durables are up, and the banks are up. And just to play off the idea, it's typically the credit market which is more sensitive to risks in the world. They certainly were expressing those risks in late November, December. You saw those declines. And they're at least suggesting now, okay, the pace might be more moderate than we may have hoped, but it's certainly positive. And we don't really feel like you're creating the conditions for a credit problem leading to a broader economic problem.
Yeah, so maybe a false alarm late last year, at least that's the hope.
Or we've repriced in the idea that maybe markets aren't at the straight lines that make for bad media, make for bad interviews, but might make for easier sleeping at night.
Been a straight line since December 26th. We'll see if that has to chop around a little bit more.